Good evening, everyone. Welcome to today's session. Myself, Vineet Mittal from Treasury Solutions Vertical at IFA Global. First of all, I would like to thank you all for being here on this platform. Of late, we have witnessed the volatility being on a rise in all the dimensions concerning global markets. Major contributors being the Russia-Ukraine war, the emanating inflationary pressures, shift in central banks' stances, rising interest rates, recessionary fears, and many more. Hence, we at IFA Global thought of sharing with you all about how our Indian markets positioned amid all this gung-ho. What are the ways in which risk can be tamed in such circumstances? How to safeguard the business margins? Where does the profit opportunities lie? And the most relevant macroeconomic indicators that one need to have a watch upon. It gives me immense pleasure to introduce to you all our today's speaker, Mr. Abhishek Goenka. He's the founder and CEO of IFA Global. Under his leadership, IFA Global has catered over 900 clients with management of forex exposure of more than $20 billion. Mr. Abhishek is a well-sought marketeer for his views on financial markets by business news channels and business dailies. So post-presentation, we'll have a question and answer session where Mr. Abhishek will be answering all the queries. So without any further ado, let's begin today's session. Thank you.
Thanks, Vineet. Thanks. Welcome, everyone. Good afternoon. And thank you all for taking out time on this Friday evening. With me, we have my team members also there. Purav, Nitika, Anurag, Mosha, Vineet, and the entire team has arranged this webinar. And we have tried to keep it as broad as possible. So there are some very, very interesting takeaways for all of you. Some of you who have attended our webinars in the past, we have always had some very, very interesting takes. Today is not going to be any different. So are you ready? Let's have a lot of conversation. Let's not make it a monologue. So whenever I'm asking you anything, just write why on the chat box. Or in case you're not understanding, just say, I don't understand. So it can be more interactive and we can all learn from each other today. So are you ready? Can you hear my voice loud and clear? Just say why. I can't see any messages. Yeah, excellent. That's it. So the world has changed, I think 2022 was an extremely, volatile year. At one point of time, we had fixed income, worst drawdown in fixed income ever, seen in the last 100 years. I mean, there was a time when the US interest rates hit all the time to 4.3%. And when central banks were raising interest rates, on bond and equity portfolio together, there was a drawdown of 20%. Now, just imagine the world where people had issued 30, 40, 50-year, 100-year-old bonds, and there was drawdown of 50% in bonds in case of Austrian bonds, etc. It was a very, very different and crazy environment. In equities, major equity markets, especially high beta equity markets like NASDAQ, where people were, had crazy bets, the valuation was crazy, and it was like a zero coupon bond, because the interest rates were rock bottom. And when the interest rates started going up, people started selling assets which were not creating cash flows. Hang Seng went down crazy. I mean, China was quoting at 7-8 PE, and various funds like Cathy Ark and all were like 60-70% down. Teslas of the world were down. Commodities had its own seesaw movement. All the way we saw gold started moving up, but crazy move in natural gas, crazy move in crude oil, and agri index because of Russia and Ukraine war. And FX, we have seen it in the past also. This was again not different. Japanese yen going all the way to 150, pound crashing like it's a small cap stocks. divergent monetary and fiscal policies over there, euro crashing. So the world was very, very different, and people really didn't know what's happening. I personally believe that whenever we see situations like that, you need to have a bird's eye view. Just imagine as if you're out of the earth sitting there, and then start seeing that where is the opportunity. And I think some of our clients would say that we were one of the first proponent who were going short dollars at euro close to parity. We never took long-term hedges in terms of euro GBP. And also we started buying global assets. I think there's a beautiful post that we had put today. Most of these assets are up now. So well, this was history, as I was telling that if you see central banks, 2,700 basis point, and all the major economies were raising rates, and stock and bonds minus 20%. So this was history. Now, what's the base case for 2023? Now, things are slightly looking better. Interest rates have gone up a lot. Inflation is slightly getting in control. Communications are coming where 1 or 2 rate hikes might possibly happen, and the 10-year bond yields have retraced a little bit. So when the central banks were committed to keeping interest rates higher for longer, the pent-up demand which was there in the system is getting reduced because people had a lot of money to spend. Now that money is going to slowly go out. Savings are going to run down, and more people are going to come into the market for looking at jobs, right? But we are already seeing stress because of the recessionary environment, higher interest rates, companies are laying off. So wage price inflation could come into control. And slowly and steadily, I think, as per the Phillips curve, what we have shown on the right, as and when the unemployment starts increasing, the inflation also starts coming down. Of course, I'm not saying that inflation is going to come down and it's going to come down drastically. There will be bouts. Obviously, there will be slight inflationary environment, but obviously it's going to be better than what we saw in 2020. So let's have something as a poll, which is let's have your view about which asset class you feel is going to outperform in 2023. Of course, it's like somebody having a magic wand, but let's take a call. What do you feel and why? Right? Excellent. So I'll launch the poll. Can you all see the poll here? Just say yes, 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 so that I know. If the developed market bonds are nothing but developed markets, DM is developed market bonds. So whatever points you have, just mention it on the chat so that I know. Thanks, Mani. Thanks, Abhay. Thanks, Arvind. Thanks, Arvind. Thanks, Bharat. Thanks, Debashish. Good to see you. Thanks, Julius. Thanks, Mehak. Could be some interesting takeaways, Mehak. I think sometime back I was sitting with Mehak. She's one of our clients and in Delhi, and we were talking about buying Nasdaq. Mehak. Nasdaq is 18% up from there. Yeah. Thanks, Prasad. Good to see you. Thanks, Raj. Thanks, Subhash. Lovely. So, interestingly, I'll poll the results. So 23% people say it's going to be 10-year bond. Gold 32% and crude 10% and rupee 13%, right? So you see that 23% have sold for 10-year bonds. Now, even I feel that there could be possibility that bonds, 10-year bonds could outperform. And anybody who has hold 10-year bonds, can you just put the reason why you feel that 10-year bonds are going to be the best performing? Anybody? Okay. I think I can't see people's messages. But anyways, so of course, let's look at this. So I'll come to the point where I'll tell you that why we feel 10-year bonds later. Maybe it's in the further slides. So before we move forward, let's discuss a little bit on FX, and I'll come to bonds later. So in FX, I think the most important thing, as per my experience in India, is of course India's balance of payment. It's nothing but demand and supply of US dollars, right? And in the balance of payment, I think the most important thing is current account and capital account. Now for FY23, we had a difficult situation where our exports went down, energy prices went up the roof. Typically, when there's a lot of risk aversion, the energy prices also come down, and there's a lot of capital outflow. But this time around, the energy went up all the way to $100, $110. And there was a huge capital outflows that we saw around till June. I think we were at 250,000 crore of FPI. And fortunately, everything got supported by Indian money. But we lost money on the current account front and capital account front both. And we had a balance of payment. Possibly we'll end up with a balance of payment minus of around 30 odd billion. But I think next year this is going to improve, because back to back India doesn't have a balance of payment negative year on year. Even if I have to take conservative numbers where I've taken oil as $90 per barrel, we are going to see a current account deficit of around $70 billion. Service exports have taken the same. Remittances are going to be similar. And FPI have taken 10 billion plus, because back to back FPI also we don't see negative year on year. ECBs I have not taken much, because anyways, people are not going to borrow from abroad if the interest rates are going to be high. FDI is broadly the same. So I think next year should be good for India's BOP, and that could support the rupee. And the third most important point, so current account, capital account, third is RBI function. And RBI function, of course, as we know that RBI's mandate is very, very clear, that they want to reduce the volatility in the market. And we have seen this graph over here. You see the walls used to be around 20% in 2008-9. Slowly, as our external debt to GDP have improved, our reserves to GDP have improved, our reserves to debt has improved. And as a country, we have become more stable. This volatility has come down. And I think this is a very, very strong mandate of RBI. Whenever things go horry, we start having those history of what happened in 2008, what happened in 2000, what happened in 2013. But you have to understand the walls have been coming down. So the risk that you can take for shorting dollar, that risk can be increased a little bit, and RBI tries to buy and sell on both sides. That's again based on rear. Rear is 40 currency rear, but in this case, we are taking China because we don't have a data for 400, but China is very, very important for us because it's a very, very important trading partner. And for China, what we have seen is that whenever the rupee comes to around 1120 odd levels, around over here, if you see, they start buying, and over here they start selling. So if rupee gets too strong, then there is a risk that our exports might get hit. And if the rupee gets too weak, then in that case, we might import inflation. So RBI is managing on both sides. Forward yields, now that's something which RBI is also managing by intervening in the spot market, forward markets. They have a separate forward book, I think $11 billion, and almost $570 billion in the spot market they have. And the premiums hit all the way to 175, 165 when the spreads had narrowed down a lot between India and US. But going forward, we feel this premium is going to go up once the spread starts increasing a little bit. Maybe we should end up the year by around 2.7, 2.8%. I don't think 2% is sustainable. And there's a huge focus on reserve accumulation. And that's another reason why, I would say rupee is slightly underperforming right now, because somehow I think the RBI feels that a good amount of reserves gives cushion And if there is any tapering or any kind of a situation because of higher interest rates, if there is any kind of bust across institutions or anything like that globally, if you have good reserves, you can manage it well. That's the reason whenever it's coming close to 80 half or 81, dollar is getting bought. And I think they bought around $30-40 billion after the last mess that we saw in terms of losing reserves left, right, and center. And beautifully, I think they're doing this because we had reserves, they could use $60-70 billion in intervention and they could protect the rupee. I mean, a lot of people don't know that actually the dollar became strong by 20%, whereas the rupee became weak by only 10%. So it's a very beautiful thing in rupee is that the beta of rupee is a little less. So if dollar gets strong, it's almost getting weak by around 50%. And if dollar is getting weak, rupee is a little underperforming. And that's what we are seeing right now. And when the dollar became weak, the euro went up, GBP went up. The rupee only became strong by around 1.5-2%. So that's the typical nature that we are seeing in terms of rupee. So if you combine these three factors together, and after like 18 years of hardcore research, we start looking into day-to-day data. We have made a model of our own, current account, capital account, and RBI action. And those models have been derived in a most quantitative manner, back-tested, checked for standard error. And then we thought that, people might have their own biases. Clients might have their own biases. I might have my own biases. You might get influenced by whatever is the next news. For example, right now, Adani news is ruling in the market. Now, you might suddenly feel very pessimistic. But let's get to real facts, real data, and then take a call, right? So some of our clients would know that we send them every day a hedging parameter number. Now, that number changes based on three factors, and which is the mother of all factors. And that's crude, which is very, very important when you talk about the overall current account. If you are losing money because of ECB or FPI flows or NRI deposits, or you are attracting money because of ECB flows, ultimately it's a matter of US real rates, which is nothing but nominal rates minus break-even. And third is the RBI function. And RBI function can be managed through walls, tracking the walls. The spot call correlation, RBI interventions, NDF markets, the mother of all factors is walls. If you do these three broad parameters, everything comes into it. And the standard error of these three factors are very less. So you can use that. And along with it, we put some couple of technical factors just for confirmation. And accordingly, we get 5 scenarios. And beautifully, what we have done is all these scenarios and all these numbers that we get, we embed with the hedge ratio of the client. So if the band of the hedge ratio is 50 to 70%, based on the number what the model throws, it is 55, 60, 62, 65, 67, or 70. So anyways, you're playing within that band. But then band becomes very, very scientific. That's the entire objective, right? Now, again, as a firm, some of you must know, and our clients will agree to that, we are very quantitative in nature. We would not like to take qualitative bets or qualitative discussions a lot. Whatever discussions or whatever data we want, we would not require actual data. So since it's a situation where importers are getting very, very, uncomfortable in the market, what we have tried to do here, and we have tried to make various policies also based on this, is what's the best strategy for an importer, right? I think, Rajiv, you're sitting there. This could be a takeaway for you and some of the importers who are there. Now, there can be multiple strategies you can do. Of course, we all know if you keep your position unhedged for imports on a long run, 5 years, 6 years, 7 years, you're going to make money. But then what happens is the standard deviation, that is a risk of keeping that strategy, is very high. You might lose 10, 12% on one LC. And the maximum loss that we see is around 9 rupees. It can happen. The maximum gain can be 7 rupees. But the Sharpe ratio is very poor. So if you ask me, you can run it, but then you should have the stomach to take that kind of volatility. Out of the money call options doesn't make sense. Seagull is very good. Seagull has a very good risk reward. Of course, but the standard deviation is high. You should be able to absorb the volatility, especially in markets like 2013, 2008, or 2022. Somebody who wants to play it safe and wants to reduce the premium cost by, say, it is paying 50 crores of premium in a year and he wants to reduce it by 10, 12 crores, then possibly a risk averse strategy where he can save 11 paisa. This is for a 6 months horizon. So around 20 paisa on a 1 year. But if you add combination of walls and you change the strategies based on walls, and this has again been back tested, walls above 6.5, walls between 5 to 6.5, and walls below 5%. And walls below 5% is important because that's the time when the carry becomes high, people start getting comfortable, start selling dollars, and they're like, it's not going anywhere. And that's the time you should move to forwards. So of course you can discuss with our team members for the details, but the point I want to make here is there are solid systematic strategy. If you run year on year, you can reduce your import cost by around 25% as per my experience and as per data. Right? Are you with me? Any questions? You can just message on the chat box. Our team will be happy to answer if there are any questions like that. Right? Okay. So we'll have some takeaway for the exporters also. Of course, a similar strategy can be done by exporters. Of course, forwards works best for exporters. Only under situations where there is extreme volatility, beautiful options can be done. One of these options is also barrier option. A lot of bankers are coming in and giving this, so we thought we discussed it. This is basically when you feel that rupee is in a slow depreciation mode, you want to forego a part of your forward premium and you want to sell a call which only gets triggered once a barrier is getting hit. This option also works well under certain environment, not in all environments. You have to look at the walls and the risk return trade-off. And then this is one of the options which can also be taken to generate some alpha in a low carry environment. But this is something which I am getting a hunch which is happening after this war, is that governments are talking to each other and de-dollarization is happening. They are talking because of digitization, because of China taking steps, situations worsening between Russia, Ukraine, China, US, friendship between Russia, India to reduce import cost. There will be various blocks that will be made where people will start trading with each other. And I think this is the new normal. And we are going to see more and more news like that. One needs to keep watch. And that's another reason why I feel whenever there's a crisis, US dollar will get bought. But broadly, what US has done with Russia, forfeiting their reserves, and now China has another problem. They were exporting to US and then parking their money into US bond markets. I don't know whether it's going to be the same phenomena. I'm still yet to get the answer. Where is going to be the Chinese money going, if not US? But then definitely it's not going to be the same because everybody is getting concerned that our reserves, US can just confiscate. There is a war kind of a situation or something which is against the likings of America. So quick FX takeaways. We feel that Fed is kind of nearing the end of its hike cycle. Maybe a couple of 25 basis, still an uptick. For India versus, I think the only concern that we have is energy prices. Rest India is okay. In terms of if oil is at $90, we are fine. We can fund it through our flows and our domestic money, etc. I think our current account and capital account are going to be better, as I shared earlier. And rupee is slowly, the volatility is further going to come down. It's a low beta. It's 0.5 in case of appreciation of dollar and less than that in case of depreciation. Time and again, whenever there is because of higher interest rates are there in world, there will be some crashes happening sometime in US, Europe, India, China, etc. Dollar is going to get strong, but broadly, I feel because interest rates are getting topped, we are going to see slow depreciation of the US dollar. Already 10% have happened, but I could see further depreciation. So dollar is a sell. Forward premium is likely to remain widen a little bit, and possibly 250, 260 is going to be the premiums. Now, understanding FX without understanding fixed income may not be true. And I think people ignore fixed income, too much of focus is on FX. But look at what happened in Adani. Now, the fixed income market started crashing first. I mean, the bond starts crashing, the value of the bond became 65, 70. And that gave a signal to the equity markets also. So understanding fixed income is very important. And for especially companies and even individuals, I'll tell you why. Globally, it's a very big market. And as India is getting more matured, fixed income is going to be invoked like in America. Credit spreads, which are the proxy like 10-year GSEC versus AAA NBFC, etc., are a proxy for equity risk premium. If those goes up, that means markets are going to be dicey, etc. So if there is anything specific on the fixed income part also you want me to cover, just put on the points and our team is going to inform us and we'll cover that. So how many of you really track fixed income aggressively? You can just say why. So I come to know that people are tracking fixed income aggressively. No? Anybody? Yeah. Yes. Devashish, of course, you are a backer. You would be tracking. So I'm not going to get into details, but then the hard work, we do it for you. But these are very, very attractive levels in terms of bond OIS spreads, MIFR OIS spreads. I think bond OIS is 150 basis point spread, that is buying bond and selling OIS in the market. Okay. So now this is an academic question, but it's very, very important for you. And now this poll is connected to my earlier poll. That what do you feel? And I want to think and answer. And you can do the maths. You can take 30 seconds. What do you feel is going to be a return on a 10-year-old bond? First of all, how many of you people actually invest in a 10-year-old bond and take it as an asset class for your investments or for your retirement or your asset allocation? Just say why. Kamal, Rajiv, Ravna. Anybody say why? Have you invested in a 10-year bond? Ravna has invested. Okay. Excellent. He has invested. Okay. Let me share the poll. Okay. So this is the answer. You can choose your answer. If it falls by 1%, what will be the return for you after 1 year and after 2 years respectively? Okay. If it falls by 1% after 1 year or after 2 years? Why nobody is answering the first and the second? The answer is going to be first and the second. Things like, why I'm showing you this? Because you will start taking bond as an asset class. I mean, we all know that FDs are history when the interest rates were low. And FDs anyways is taxed, marginal tax. Whatever money you get out of interest, you can't reinvest. There is a reinvestment risk, there is tax. So bonds are definitely better. You put it for 3 years, you get indexation. And post-tax today, you're getting 10-year at 7%. That's fantastic. You get 7% for the next 10 years. You can get 7% for that. So that's a no-brainer. The question is whether you should take duration or not. So I'll share the results. And Paul share the results. Okay, so 21% have said it for 40 and 10%. Okay, and 32%, 7 and 7. Okay. So one thing is for clear, a lot of people are not having 100% understanding. I understand that you don't do it day to day, but because the interest rates are moving up, and yields are moving up, your returns on the overall bond is going to also change. And that's very important to understand and how you can take advantage of this asset class. So over here, just look at It's actually 14 and 10%. So just take an example like this, that today the 10-year is at 7.3. If you feel that RBI is not going to raise interest rates aggressively, maybe one next, and they're looking at US, that they don't need to keep increasing interest rates. Our inflation is broadly in control. It's only because of America and the Western world that we have to increase interest rates. So if they stop, we stop. Now, if our rate cut is going to be 1%, 10-year bond that you are holding is going to give you 14% interest. And if it's that cut happens within 2 years, then you're going to get 10%. Even if it doesn't happen, it happens in 3 years, still you're going to get 9%. I mean, in a world where getting 10, 11% nominal in equity is becoming difficult, because if India grows at 5.5, 6, inflation is 5, in equity you're going to get 11. So an asset allocation where you are taking broadly no risk when you are in a government of India bond, and you are going to get a return of 14% or 10%, I think it's fantastic. So why? I mean, all the money has to go to equity. The world has changed. I was talking to people in America, pension funds, large investors, or talking to people who are working with BlackRock, Blackstone, etc. They're all saying that asset allocation have changed. 70-30 portfolio is not needed anymore. A 40-60 equity, 40 equity, 60 bond, 50 equity, 50 bond is sufficient, because at US, they're looking at 7.5% of return. In India, sophisticated family offices are not looking at 11-12% and more. So what if you do a 50-50 allocation? This will serve your purpose. Okay. For a 10%, even a 10-year bond is going to serve your purpose if 1% interest rate falls like that. So this becomes a very, very interesting asset allocation. And in fact, this slide was prepared a week back. And already I think the bonds have corrected today. And there are already some money made in the 10-year bonds. So this is one very important takeaway. I hope you have understood this. Just say why, and how bonds are important. So, and historically, what we have seen is that, whenever the interest rate cycle starts topping out, we are seeing an average of 1.5-2% of cut. I'm saying in case of India, interest rates move all the way from 3.35 to say 6.5, didn't move a lot. Whereas in America, it went almost 0 to 4.5, 5. So our cuts are not going to be very, very high, because anyways, inflation is not going to go up a lot, go away a lot. Slight inflation is going to be there. So even if it is a 1%, 1.5% cut in the next 1 year, 1.5 years, you're going to make money, right? So, and beautifully, the large gilt funds are already, starting to increase the duration. So SBI, Magnum Gilt Fund already have a duration of around 6.2. They have increases from of 3.6 and SBI has 6.2 and the average is 3.6. So the duration have already started going up. So people have understood that right now is the time to start taking duration. So people who are in family offices, I think time to start looking at bonds in case you're not looking at. Although it's already given a part of the gains, but still it's not bad. Now, in India, I think somebody can answer, Julius. Julius says, what's the strategy if interest rates keep moving higher post your investment? So interest rates can still move up in the short-term rates, repo rates start moving up, but the yield is going to get inverted. So we feel that there is more than a 90% chance that even if the interest rates go up, we are going to see good returns in the 10-year bracket. So with an average duration of around 7 odd, we can start seeing money. And even if it happens for some time, if you're holding it till maturity or even for 2-3 years, I think it's going to give you return, right? So we have positioned ourselves and started taking duration in a 10-year bucket. So I think for India, I think always there's been a concern of fiscal deficit. Together, I think state center around 9%. India's public debt to GDP together is 90. We are moving towards 60. Slowly GDP will improve. Debt is going to come down. In this budget, fiscal consolidation was given focus and a huge, tremendous focus on capex. They have increased the capex by 33%. That means the quality of the spending, which always India used to cry, because a lot of money used to spend on revenue, salaries, etc., and interest. The quality of the capex is going to be, quality of the spending is going to be towards capex. And as we know that capex have a great multiplier. You spend 1 rupee it works for 2.5 rupees. In the multiplier is 2.5. And over a 4-5 period, it becomes the multiplier becomes 4.8, like we saw here. Whereas in case of other revenue, it's 1:1. So the world knows that if you're not spending, we don't get super GDP growth. That's what I think this government is doing, and that's a good thing. And I think there was not much negative in this budget. I think it's a great budget. Net borrowing, that's another thing what the bond markets were concerned, that they would be increasing the borrowings. But I think they have very well managed the borrowing between 11.8, which I think they will be able to borrow from the market. And the small savings, they're managing very well. For the women, what they have brought in for 2 lakh crores and also increase the cap from 15 lakhs to 30 lakhs for senior citizens. I think they're going to get some money on the small savings. I don't think they have to go and hit the market a lot. Some rollovers are going to be there for the extent of 3 lakh crores, but I think that's pretty manageable. So our bond markets reacted, and today I think the bond markets have also reacted based on that. And we have seen the yields actually coming down. So OIS is inverted. Now, why OIS is important is it just tells you the future trajectory of interest rates, what the market is expecting about the future of interest rate. Like we have a forward premium in case of dollar rupee. OIS simply tells you what's the expectation of interest rates in the future in layman terms. And this OIS curve, 1 year, 5 year is inverted. That's 50 basis point negative. And that's also an indication that longer term the interest rates are going to go down. And in the past, what we have seen over here, that when the OIS was around 0.5, the spread between 1 year and 5 year was negative 0.5. The interest rate started getting cut from around almost 8% to all the way to 4%. And then again, now this time the OIS spread is close to around 0.5. So very high probability that we are going to see a topping of rates and then followed by cutting of rates. And that's the reason the long-term bond markets, which is signified by 10-year bonds, that has started reacting in the market, right? So OIS is also very important to understand that, I remember at 335 when the repo rate was going and reverse repo was around 335, I think that time. We were talking about hedging your interest rate liabilities with the banks through paying off OIS. And I think that trade has paid very, very well. Especially people who can do that kind of trade can actually book profits now, because now the rate cycle has topped. So understanding this interest rate movement is very important for your investment portfolio. That is for your corporate money and also for your personal money, and also for your liability book. But how to position your liabilities, what to borrow, dollar, rupee, short-term, long-term, floating, fixed, everything gets very, very easy, right? Are you with me? Just say why. I think it's getting a little technical, but I hope you can take some interesting takeaways from it. Is it getting technical? Just say no in case it is. Yes, Ajay. It's getting technical. So why means technical. Amrendra? Okay. Just understand that understanding bond markets are important for your personal, professional, corporate, investment, borrowings, etc. Even if you have a home loan, it's important. Right? Okay. Now, in terms of money markets again, money markets, we are seeing that liquidity has come down a lot from 8 lakh crores to 2 lakh crores. CD, CP rates have gone up to the roof. I mean, if anybody runs a family office and he wants to participate, he can just go and buy corporate bonds which are holding duration of 1.5, 2 years, and they can participate in the 7.8, 7.9 because the banks are rushing for deposits. Everybody is rushing because a huge credit offtake, liquidity is less, and they're all looking left, right, and center. They're not getting enough CASA. They are borrowing through CDs and CPs in the market. So that's another. Now, one more important point that you need to understand that when the liquidity reduces in an environment, when the interest rates are high, there could be some skeletons which are coming, which could come out of the system. Adani's case was not a skeleton because there's a lot of other reasons, but we can all understand that when I talk to companies, they say at 9%, 9.5% interest rates, our business are not going to be, lucrative. Everybody cannot get an ROE of 15%, 18% on their businesses. Some of the businesses just don't have that kind of ROE. So If the interest rates are high, liquidity is tightened, you might see some skeletons out of the woods. We have to be wary about it. And that's another reason why, if you're investing in a corporate bond, then you have to be extremely, extremely careful, because the spreads are not lucrative. Now, look at this. Over here, the 10-year AAA PSU spread, 10-year AAA NBFC spreads are pretty low as compared to what the markets used to be. During COVID times, it had really shocked. But right now, there's a lot of comfort in the market, I would say. The spreads have not gone up. But I feel that sooner or later, these spreads are going to go up. So if you want to take duration in a bond, take a government bond. Don't take a lot of AA or poorer bond, because they are not valued correctly in the market today, because the spreads are low. The spreads go up, then you start taking a little bit of corporate. But as of now, doesn't make sense, because ultimately these spreads are going to go up. And when the spreads go up, even if the interest rates yield starts falling, you are not going to make a return on investment. So be careful when the spreads are on the spreads. So some takeaways: government borrowing looks manageable. Prefer G-Secs on corporate bonds to add duration. Borrow floating. Interest rates are at top. Why do you want to lock anything on fixed? And at 82, 83, if somebody wants to take a bet, he can borrow in USD also, because USD rates are going to come down. You can borrow in USD, buy a call option, hedge that loan, and you can make some good money over there. Don't get into that recency bias of the rupee has depreciated and it can depreciate more, etc., etc. Look at the risk reward perspective. It is already sitting at 11%. Average depreciation is 3%. So can you make money? I feel there's a high chance you can make money. Buy an out of the money call option and hedge it. That's all. And OIS I just mentioned, and then 1 to 2 years, very, very good corporate bonds are better than as compared to MD. Definitely. So no discussion can go before equities. So we covered FX, we covered bonds, and now equities. Now, over the last 6-8 months, some of my friends who are also here, they would vouch that, I think Devashish, you will vouch that we have always been extremely not very comfortable with Indian equity valuations for the last 1 year. And I think I've been strong proponent that the 70-30 portfolio is not going to work, and a strong case for bonds. And that's what I think Prashant was also showing in one of the webinars in White Oak. And this is the slide which we've taken from there. If you compare the MSCI valuations, because China was quoting very, very low, we was quoting at a huge premium. Look at this valuation over here. And the Sensex forward PB was also around 21. When the world is crashing, 21, I still feel that there could be some more room to go, and until unless we see the earnings revisions happening, we could see more fall in equities. Historically, the price to book was also around 2.6, 2.7, and we were quoting at around 3.2. So I think with this recent saga also happening, I think possibly equities could correct a little bit more. And in fact, more than Indian equities, around 3 months back, I started liking American equities, because American equities, when the interest rates were at 4% and American NASDAQ high beta had fallen down a lot, we started investing there. Because over there, the valuations had almost come to historical averages. I'm not saying it cannot go down, but then they start buying at good levels, and you can obviously add more. But that 35, 40% down NASDAQ, I think it makes all the sense to go long. I think it's already moved by 10, 12%, 15% from there. So Indian equities are expensive. Chinese equities were cheap, because Chinese equities went up by 50%. Indian equities, I think it will be a lot of time correction before we can see a better than bond market return, which I just showed you, 14% in case 1% fall. I would rather take a duration on a bond rather than take a call on Indian equities. I'm not seeing 18,500 in the next 1 year. Now, this is something that we use a lot of times when we have to take a call on a combination of bond and equities. Now, this is a cycle which keeps going on. Just spend a minute understanding this. In various cycles, in various part of the quadrants, the markets are going to behave in a different manner. If you see on the orange one, the RFR is nothing but a risk-free rate, which is overnight rates. And market risk premium is nothing but the expectations of the market out of equities. So if there is a recessionary environment, the market risk premium goes up. In case everything is hunky-dory and the interest rates fall down a lot, people don't have much option to invest, and there is liquidity, the market risk premium starts decreasing. So when the COVID struck, everybody was like, what's happening, etc. Government was cutting rates, people were scared. So equity crashed, and the bonds started becoming bullish, right? Now, then later on, they started printing money, started giving liquidity. So the bonds were bullish because interest rates were low, but then the equities market started also going up. Post-COVID, there was a huge pent-up demand, and inflation was increasing, so bearish for bonds, but bullish for equities because people were like, okay, big deal, things are going to be okay, short-lived, etc., etc. And now, when the interest rates were at 4.5%, that time it was bearish for bonds, but they're ultra bearish for equities. I'm not sure whether we have come out of this phase or not. In case of India, could be maybe we could enter into this phase where we could be slightly ultra bearish for equities for some time and then move to the orange one where the bonds could start getting bullish again, especially on the 10-year bonds, which I mentioned. Even if the short-term interest rates start moving in, the 10-year bonds yields could start dropping, and then it could be bullish for bonds, and you can make some returns on 10-year bonds. And the market could have time corrections, so it could still be bearish for equity. So I think a combination of these factors, and it's always like a cycle. If you follow one of the interesting gentlemen, Mr. Ray Dalio, he talks about inflation, interest rates, how this entire economic cycle is. I think on a similar lines, we have made something. And I think whenever you have this question, bond equity, bond equity, bond equity, open this and try to understand that what the market is feeling in terms of risk-free rate and market risk premium. I think in the current environment, when the interest rates are high and there's a recessionary environment, I think the market risk premium has gone up. That's the reason people are moving into bonds, right? Are you with me? Just say yes, yes, yes. Okay, so this is what I was telling you earlier, that AAA bond spread, which is a good proxy for market risk premium, is actually at all-time low. Now, if your interest rates are high, by common sense, there will be some companies which are going to go bust. There are going to be some companies who are going to be highly leveraged, and those companies will not be able to pay debt. And that's a time when these AA bonds or lower, their spreads are going to go up. So I think it's not a great time. And when their spreads go up, the market risk premium will also start increasing, and Nifty or equity markets are going to correct. So in case of India, I think you need to track the spreads of between 10-year AA and 10-year G-Sec spreads. And if those spreads start going up, it could be a warning call for equities also. So don't feel that I'm extremely bearish for equity. What I'm trying to say is that possibly there could be 1.5 years of slight bearishness or time correction. So it's not going to go anywhere. Already, I think 1 year has passed and nothing has happened. I think there could be another time correction for 6, 7, 8 months, or maybe a year, where you may not get supernormal returns. So possibly you can have some positioning in bond markets, which are going to take care of your returns. People who still want to go active, I think this is some exercise what the team had done. Every single sector, we need to understand the risk and returns. So the sector's average returns is shown in form of means, the risk in form of standard deviation, Sharpe ratio, higher the Sharpe ratio, the better. The beta, how much risky the portfolio is or the sector is, and how much it is moving as compared to Nifty. And the market risk and non-market risk is unsystematic and systematic risk. So I think in the environment where risk is not completely like everybody doesn't want to take risk, people are a little scared. I think defensives in terms of Nifty Pharma, FMCG, where the Sharpe ratios are pretty okay, returns are not bad, and the systematic risk is low. So why do you want to take a systematic risk right now? Let the markets correct, let the interest rate cycle come down, then start loading on risky assets, right? Then you can buy a small cap, but at this point of time, I don't think it's a great time. You can still be playing a little defensive, and I think that's a work well also in the markets. flows in equity mutual funds broadly has been coming down. So low beta, value stocks, select mid caps, time to go. Doesn't make sense for indexes right now. In the view of widening credit spread, we expect the market risk premium to rise. That means people will want more return of equity, overvalued. So have a combination. Now look at this. Everybody, when we talk about investing international, Meta is looking good, Amazon is looking good, Apple is looking good. I think that's a very myopic way of looking at global markets. So people just go and buy FANGs. There is a FANG index, so there's a FANG ETF, etc. I don't think that's the right way. The right way is first use data. Because we are beautifully placed in India, we are dealing in INR, right? And people who are here, they understand the nature of INR. Broadly depreciates by 3% year on year. The correlation when you are investing, no, let's assume that tomorrow there is a stress in America. What's going to happen? Rupee is going to depreciate and global equities are going to fall. But that depreciation of rupee of 5, 6, 7% cushions you from the fall in Nasdaq. So if Nasdaq falls by 30%, Indian rupee depreciates by 7%. So your correlation is positive, negative. And it becomes more negative when there's a bigger stress. So it protects you. So if I put maths around it, if you invest in global markets in INR, that's the time you get a higher risk-adjusted return because you have a negative correlation. The Sharpe ratios is very, very high. I mean, just look at the Sharpe ratios of Nifty and others. I mean, and other sectors, they were not as good. When you put INR with investment in Nasdaq, you can look at a return of around 17%. And this is a data of, I think, 7-8 years, I think. And standard deviation is of 21%. And in case of S&P, which is much more diversified portfolio, look at S&P. And that's the reason people with large family offices who are stationed in Singapore, they're not just gung-ho about Indian equities. I think Indian equities is overrated. I mean, talk to a Canadian, he will say, buy invest in Canadian equities. 60% of people invest in Canadian equities. Talk to a UK guy, he'll say UK equities. That's a home bias. That doesn't mean that's the best market in the world. Yes, when we see CNBC and we listen to all the fund managers, we always tend to think that, but it's not the fact. US markets are still much better than Indian markets. Look at this. In INR terms, S&P gives you 17% returns. 13% return to the standard deviation of 17%, which is less than Nifty standard deviation. So you're taking less risk, getting more return with a better Sharpe ratio and a well-diversified portfolio. So it definitely commands a part in your portfolio, and you did not go very aggressive on few stocks, 5 stocks, 6 stocks. I mean, you can very well go for a diversified index fund, it will work, REITs. I mean, people just go and buy commercial real estate and then get stuck into it for 4 years, 5 years. How many of you have an experience of getting stuck in commercial real estate? Just say why, where you're not getting a yield of even 5% and then you're not able to sell, What do you feel? Anybody's got stuck in commercial real estate? Anybody? Where it's a large chunk you're not been able to sell. So you can just go and buy REITs in the market. REITs are giving you on average 10%. In fact, last year, our multi-asset allocation portfolio did so well because we had a good portion of REITs in that. It gave 22% return, dividends and capital appreciation. On an average, it is given 10% return. So why it does not command a part in your asset allocation? You should have REITs. And there are good companies which you can have in REITs. And over here, we have seen Mindspace and Brookfield, they're doing well. The occupancy ratio is more than 87, 88%. And drawdowns are not very high. So why we should not look at REITs? And also for active funds, one thing is for sure, large cap active, in case you have in your portfolio, get out. 90% will not be able to outperform active funds in case of large cap. Mid cap and small caps, yes, active funds. There also you look at your Sortino ratio, Sharpe ratio, drawdowns, AUM size, and then take a call that where do you want to invest in terms of active mutual funds. Small cap broadly it outperforms, but then the problem with small cap is 5 years there will be no performance. on a 10-year period, you will still be able to outperform in small caps. AIFs are very much in vogue, but I always tell people that when you are investing in an AIF, why do you invest? Is it because you want to feel nice? Is it because you want to invest because of knowledge? Or is just a snob value? Otherwise, if a normal combination of equity, debt, REITs, etc., can give you 12, 13, 14%, a little bit of reject, maybe you don't require an AIF in your portfolio, because there's a fee, there is a tax, there is churning, then you come under short term, and then carry for the fund money. After that, 2-3% extra gain as compared to a mutual fund is needed to actually give an outperform an active mutual fund. So the question that you need to ask is, do you really require it? Does it require in your asset allocations? Maybe for a startup, private equity, but I don't know how many private equity firms would be able to give 20% plus CAGR in Indian environment, or how many VC funds would be able to give. I think not more than 10-15%. So you need to get those funds right in your portfolio. Otherwise, I don't think you're sacrificing your liquidity also. 5, 6, 7 years, you're blocking your money. In terms of PMS also, I think in short term, a lot of these PMSs have not been able to outperform the markets, right? Have you seen the numbers? Anybody who's invested in the PMS? The large PMSs are not able to perform, and the compounding works. If you're taking 1.5%, 2% fees, sometimes it doesn't work. Because if you're underperforming for 3, 4, 5 years, then it's better to invest in an index fund or an active mutual fund, I think. So, but it can perform in a long term. Some of them maybe 10, 15%, but then broadly, I think in America, I think anyways, there is no generation of alpha. In India, I think next 4, 5 years, there will not be much generation of alpha, especially in the large cap category. In mid and small cap, still there could be some generation of alpha. So our asset allocation in the current environment looks something like this. And some of the clients who are sitting here, they will vouch to this. So we are largely into long-term debt. That's 10-year bonds. We have started taking duration. We have allocation to gold. Gold has worked very, very well. 15%, 16% in INR terms it has given us. REITs have given us very good. Now REITs, we have booked some profits on REITs. And now we'll start allocating in REITs again. When the interest rate cycles starts going down, the REITs will again start going up. International equity, we started allocating 2-3 months back. There's a beautiful post on LinkedIn we have shared today. And that has also moved by 15% up. So a combination of almost like 7-8 different type of products are there in the asset allocation. So what happens once goes up, other comes down. Like that, there's a combination that always reduces our risk of our portfolio by 50%. So if you get 14% by taking a 50% drawdown risk in equity, we will be able to reach 13% by taking less than 50% risk of that. So under every 10 years, our portfolio is going to fall by around 20% maybe. Whereas all around equity portfolios will fall down by 50, 60, 70%. So the only way by which you can make sustainable long-term money without having bigger drawdowns, and you can do some search, Google on this, you can understand what is an all-weather portfolio of Redalio, is by running a multi-asset, multi-geography portfolio. Otherwise, you'll always have sleepless nights. And my understanding is, in the last 20 years of me tracking markets, there will be a time when your portfolio, if it's a one asset portfolio, is going to fall by 60, 70% of the value. Look at what happened to Austrian bonds, 70% down. Equities, we have seen in 2008, 50, 60% down. Nasdaq was 40% down. If you have everything in one particular asset class, you're gone. So you cannot have that. So some takeaways, just summarizing. FX, broad USD weakness in medium term, fixed income. Your debt has to have larger allocation equities, 5 to 6 different asset classes and skewed towards low beta. And precious metal should be definitely a part of your portfolio. So if you have any questions, just message us. Meanwhile, of course, we are known for FX and treasury, doing this for the last 18 years. A very strong quantitative approach of managing hedge portfolios. And a strong focus towards wealth management, but we are not typical firm. We use a lot of quants in wealth. Try to keep your cost low. Your cost never exceeds more than 50, 60 basis points. Taxation low, low churning, and then give you a sustainable risk-adjusted return, keeping risk into a perspective, being a risk management firm, risk becomes a very, very important part for us. So risk comes first, return comes later. So with this, we'll put in your questions. Thanks for your time. And thanks for taking your time for this presentation. You can put in your questions. Meanwhile, we'll love to answer that. You want the question answers? Any questions? Vineet, I can't see the questions. So in case you have any people are putting some questions, you can just tell me. Is there any question?
Certain questions were asked, so those were answered.
Okay, you guys have answered that. Okay, excellent. We'll just wait for a minute or two and then we'll log off. Thanks, Subhash. There'll be a feedback form coming to you. Please fill the feedback form in case you want us to. And this will be a regular series. So this series will happen every 1 month or 2 months. And you can keep following this series. It will be very good from an academic perspective and also from a market opportunity perspective. And we're going to cover all the asset classes in India and global. So you get a good perspective on things. Thanks, Ajay. Thanks, Ramana. Thanks, Subhash. Prasad, I think still through an INR route, you can invest like a Kotak FOF, etc. I think that TDS thing will not be applicable then. Thanks, Bharat. Thanks. You have been you have been part of a lot of our sessions, Bharat. Thanks. Thanks, Suresh. Thanks, Hemendra. Copy of the session would come to you. Please share with your groups. Let everybody get the knowledge what we have shared today. Excellent. Thank you so much and have a great day.
So thank you, everyone. Thank you for your time. With this, we would like to sign off. Any particular questions or anything, you can very well connect us. And meanwhile, our website is there, wherein a lot of case studies can be referred to in certain doubts if they arise. So thank you, everyone. Yeah, that will be shared with you, Ramanaji.